Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier, and today it's a Thursday Market Blitz. We're going to look at any and all markets you'd like to look at. We're going to cover some breaking news items that are interesting that may actually impact the markets. Right now, the Dow's up about 315 points. We've got a key level to cover in the Dow, a trade idea. Been a real solid trading week. It's been a pretty darn good first week of 2026. I think that this is just a preview of things to come. We're going to be in line really to make some serious hay. There's an old saying that make hay while the sun's shining. Well, we can make hay while the sun's shining this year. I think we're going to have a lot to work on and a lot of opportunities here potentially to, I don't know, make some money. That's what it's all about, isn't it? Making a little bit of money here and there. I think that the big picture is that things are settling down on the Venezuela front. I think it's starting to become evident what's going to happen in that venue. We've got fresh civil unrest here in the United States, which, in my view, could definitely prompt some major action on the risk front. So we're going to look at that as well. So geopolitics, we've got domestic issues here in the United States. We're going to look at our interest rates. We're going to take a look at the jobs numbers. We got NFP live tomorrow. That's going to be a big one. So we're definitely going to want to get live with that about 10 minutes ahead of the release. I'll be here. We'll be ready. I'll have a preview for you. And then we'll also be looking at some key levels, maybe do some live scalping right afterwards. I want to thank everybody that showed up to our Switch Markets live webinar yesterday. It was a pretty good one. The 5-8-13, we had a couple of trades that hit pay dirt, so I always like it when those trades come in. We had a really nice one on the dollar yen that gapped up right after we came off the air. Nice little scalp, sort of a little bit long to be in the market for a scalp, but I did like it anyways. And then you also had a situation in WTI crude where it sat there. The price just sort of sat there and didn't do anything. Then we took that 56 level out and jammed up and got our take profit relatively easily. So pretty good stuff on the 5-8-13. If you're interested in trading the 5-8-13 EMA crossover strategy, check out yesterday's live stream. It sort of was a little bit slow because we were struggling finding a live trade to execute, but we ended up executing two, and they both hit, so that's great. As far as what we're looking at today, I'm going to give you my read on things like Bitcoin, the US 30, gold, silver. We've got a 920 setup on silver that I don't know that I would take, but we're going to look at it anyways because it's a good teachable moment about how to trade that 920 EMA crossover potentially against the trend. Remember, the trend is your friend. Fading trends is a tough business. I think we'll have an opportunity, though, to do pretty well. Coming up relatively soon in our US 30 market, we've got a level up there that's just begging to be hit. So good stuff. I want to welcome everybody in the How to Trade community. Tuku, good to see you. Tuku, Andrea Garwal, Bobby Bob, Ralph H, Lita. Always a pleasure, guys. You guys have been with me a long time on the How to Trade venue and in the community, so I sure appreciate showing up. If you have any questions at all, be sure to drop them in the live chat, and I will pull up pretty much any market you'd like today. This is a market blitz. We're going to start with crypto. We're going to move to equities. We're going to look at metals. We're going to look at energies, and then we're going to probably take a look at some of the Forex pairs that we think may be relevant as we roll deeper to January. But it's one of those things where I'm open for business. Whatever you guys want to look at, I'll look at. Okay, Gordon Williams, good to see you. Gordon, welcome. Lewis, always a pleasure out in YouTube land. The 54 Cattle Company. Boomer Sooner, good to see you. Boomer, good stuff. Hello, Shane. Joshua Chung, always good to see you. Josh, Stephen Market, all right. Lewis, Team Arena, hey, all. Happy Thursday, Shane. Happy Thursday, everybody. Okay, that's enough of the pleasantries. Gordon Williams, good to see you. We had to get one last one in there. All right, guys, let's get on over to our MT5 platform. Now, this is sort of a layout that I've showed you over and over again. And the reason why we're doing it in this format is because I want you to really look at that gold compared to silver. I want you to be thinking about the price of gold compared to the price of silver. Now, we put out a YouTube video today on Switch Markets. I dropped it in the live chat right here in the How to Trade community. It's called the gold-silver ratio. If you're interested in metals, you probably need to understand the gold-silver ratio, or at least the concept of it. Now, what the gold-silver ratio is it's the price of gold compared to the price of silver. Nothing too fancy, right? Doesn't really seem to mean much. It means a tremendous amount. It means a tremendous amount to institutions. When we start talking about the big money players, and a lot of you are smart money concept traders, and you're traders that believe in institutional footprints, and we got to find out where the big guys are, and then we get on their coattails. The gold-silver ratio is a big guy tool, and what I mean by that is a lot of the institutions, from the folks that I've talked to in that world, they don't look at price charts. They look at things like seasonality. They look at things like potential supply, demand, and macro trends. They also look at the gold-silver ratio, especially when it comes to metals. Now, what does the gold-silver ratio mean? Check out our YouTube video. I cover it. I break down historical context, and I show you how to derive it for yourself. We're also more than likely going to have a free EA for Switch Markets clients. Actually, it's going to be free for everybody, but that's going to be dropping sometime down the line. Still have to build the EA and everything, but it's a really nice one, and the concept is to always let you know what that gold-silver ratio is right on your MT4, MT5 platform. So when we look at gold and silver, and I talk about the ratio. This is a great place to begin today. The ratio. Right now, I'm looking, okay, gold, 44.57. What's silver? Silver's at 75. A little bit of a correction the last couple of days. So very simply, 44.56 divided by 75. So the quick and dirty gold-silver ratio is about 59. Now, what that signifies is that the price of gold compared to the price of silver, we're starting to gravitate towards what we would call a par value. Now, it's never going to reach a par value, but gold right now is valued at about 59 times what an ounce of silver is. So 1 ounce of gold is worth 59 times more than an ounce of silver. That's intuitive. We all understand that. Where it gets fun is when you start looking at historical trends in the gold-silver ratio. You start looking at where that ratio gets a little toppy and where it's too low and how we typically gravitate towards a mean value. All that's in the video, and that's over on the Switch Markets YouTube channel. I'll probably show you where to find it by the end of the stream. The gold-silver ratio, for reference, I'm going to say not too long ago because I don't remember the exact date, the holidays, everything sort of runs together, but it was right at 100. It was right at 100. I believe it was when we were at 3,500 for gold and 35-ish for silver, maybe a little bit lower. That's a staggering closing of that spread from 100x, a gold-silver ratio of 100 now to 59. A lot of folks believe it's going to 30, and it's going to 30 not because gold's going to come down. It's because silver's going to go up. Everybody's on the silver bandwagon right now. Is it too late? I don't believe so. We'll go ahead and take a look at a few key levels a little bit later on in the session. So if you want to trade gold and trade silver on the MT5 platform or MT4, feel free to check out switchmarkets.com. They've got plenty of offers. They've got all the markets you could ever want. And they do have a bunch of EAs. Definitely want to stress the EAs. The trading tools, you've got all these free trading tools, but you've also got some resources here, EA tools for traders. We're looking at building an EA for that gold-silver ratio, and you can see right there, lots of deals left at least for the next 6 days. So that's sort of what we're looking at for our metals. Now I'm going to give you the key levels and everything that we need to know with regards to trading it, making these things tradable. But for right this minute, I want to get on to today's trade idea. The trade update is real simple. Put this one out yesterday afternoon. Let me see. U.S. seizes oil tankers, key level for the U.S. 30 coming up. This is sort of on the back of those special forces excursions up into the North Atlantic. International waters, U.S. Special Forces has taken 2 oil tankers that they were in pursuit of, oil that was destined from, due from Venezuela to Russia. So it was violating international sanctions, and the bottom line is they both got seized. Now, why would we say that that's sort of a market driver? Well, it's a market driver with the respect that it really represents escalation in the U.S.-Venezuela standoff. No question about it. There's a lot going on in that region. You're going to have some elections at some point. Right now, there's reports. I'm not going to report any of it because I'm not there and I don't know. But they're talking about unrest, civil unrest, groups of nationalists, not nationalists, but the folks that are in power, the sitting regime, communist regime. A lot of folks are banding together, starting to see folks lashing out at potential opposition, and that's to be expected. Shouldn't surprise anybody, but it does measure escalation when you have sort of a tender pot on the ground or a powder keg on the ground, and then you have these international actions against the oil industry, the local oil industry out of Venezuela right now. It's a tinderbox. We're watching this closely. The trade update, I don't know that any of it derails the US 30. I really don't. So this trade idea is about as simple of a technical analysis piece as I could ever do. And it's a big round number of 50,000. I love it up there. I think 50,000 is going to bring in a ton of trading, whether it's bidders or sellers. They're all going to be involved. And that's sort of what, it's like a big party. It's going to be a big party up at 50. There's going to be buyers. There's going to be sellers. There's going to be profit taking. There's going to be naked shorts. There's going to be all the action that you would ever want out of a trading environment is going to be there. So I'm sort of in the camp of not wanting to miss the big party. So the way that I look at it is I'm looking at about 49,750-ish, somewhere in there. Check out our key levels. I'm not sure the exact one, but that's pretty much what I would do. Sort of a larger risk trade. You're looking at about a 600 pip. Your stop loss needs to be up above 50,000, maybe 250, somewhere in that zone, 300. Be up above that quarter handle. I like that trade. I think that that's going to be really a rock-solid trade as we roll deeper into January. When do we get it? I think sooner rather than later. I really do. Right now we're at 49.3. We've got one eye on the unrest. We're watching the news cycle. We're watching unrest in Venezuela, and what we think is going to happen in Minneapolis is not really a good scenario. Could definitely bring more angst to the market and maybe hold prices sort of firm for right now. But I have to tell you, the macro scene is this. We're looking at cheaper energy for 2026. We're looking for interest rate cuts in 2026. It is really difficult, aside from an outlier like a COVID outlier or maybe a world war or something that we don't know, an unknown. It's really difficult to build a case for the bearish side of equities in 2026. I'm very, very bullish. Very bullish. Right now, this chart shows us just how bullish the US 30 is. We saw sort of the big correction yesterday. Nice little sell-off of about 1%, and now you're just banging higher right now, pairing those losses, really rejecting this 38% level. But it was sort of a nasty trade down there. There was a lot of angst coming into the market yesterday afternoon, especially following the shooting in Minneapolis that we're going to cover here in just a second, and what a lot of traders believe can happen here in the United States. We're going to get into hypotheticals towards the end of the stream, but it's something that we have to consider as traders. We have to make sure that we don't get left out. In any case, we got a nice little rebound here. I mean, nice bounce off of 38%, no question about it. The biggest question that I would have right now for, say, the US 30 on the daily, I don't believe that you can buy from this location. We want to be shorting at least short-term counter-trend plays from just beneath 50. I think that's a pretty darn good play. But is there any way that we could get long right now with a little bit of meaning? Let's take up the US 30 on our 920 EMA crossover. Do we have anything? On a 4-hour chart, you sort of had it on the 5th of January, and we're not really going to hang our hat on that. That was really to open the week. Let's take a look at the 30-minute chart right now. Okay, there it is. Now, to be brutally honest, I didn't even look at this chart before we came on stream. So I don't want to pull these 920s up and try to run a confidence trick on everybody saying, oh, see, this one won, this one won, this one won. They don't always win. We all know that. This setup right here, intuitively, I saw the break in the US 30 today on the daily, and I said, okay, let's go down. Let's try the 920. Let's kick the tires on the 920 and see if there was a signal that sort of suggests that maybe traders got in on this run a little bit earlier today, and there exactly was. You could see sort of the downturn that we saw really beginning yesterday morning. Bam, big time sell on the 920. That's a trend. That's a fat intraday trend. I mean, there's nothing wrong with getting in on that. This right here, nice big rally to open, and now the rebound is on. The rebound really is on, and you're sort of driving higher. So in all honesty, we probably missed this trade. Even if you had like an orb, an opening range breakout on the 30-minute chart, you can see that there's a really good potential for this market to rotate back down into this range, something like this. So if I was looking at trading the US 30 intraday right now, very simple. I would go to my Fibonacci tool, and notice I usually work a spike to spike, so I would begin my progression there. I'm not going to do that. I'm going to begin right there at the bottom of the U.S. session. Why? Because I care about where the volume is. Now, these are tick volumes. These aren't exchange volumes. That volume right there shows us that we are back in business, and you can see that this trading right in here is really what matters. Now, a lot of selling overnight, very, very, very low volume, fractional of what it is right here. So if you're looking at maybe a late day 38% buy to the top side scalp, follow the intraday pressure and the macro trend. I like it. There's no news due out later today that would derail this idea. It's not a bad one to be trading a little bit later today. So to execute, go to our trading panel. Go ahead and pull up our paper trader. Remember, ignore my leverage. The leverage and the dollars and cents here that we use are hypothetical. You've got to figure out what's right for you. I recommend 1 to 3% of your account balance on any given trade. Something like this, though, you've got sort of your order. Let's go with a buy limit. Let's drag the buy limit right down above our 38%. And you can do this visually, or you can do this according to the numbers. So 149, 136. I want to be fairly accurate with where that number is. I don't want to pad it a tremendous amount. You'll notice we're working with about a 2-pip spread right now. So we've got an opportunity potentially to make a few bucks. Let's go ahead and shade this. We've got 136 as the level. Let's go ahead and shade this up to 40, about 4 pips. Do something like that. And let's go ahead and put the buy order in the market. So it should get placed right there. So how would we execute this trade? On a Fibonacci buy with the trend, I'm looking at a take profit. We're just looking for a little bump here. So, if we're looking at buying 140s, we could easily just dial this in somewhere right in here maybe. Very, very tight. You can see exactly how much leverage I have on this trade. You don't need to have that much leverage. But let's go ahead and put something on here, maybe, 10 ticks. Something like that, maybe 149, and then maybe take our stop loss down to somewhere right. Initially, I want to start it down here, but we're going to tighten it immediately if this trade gets executed. So I'm going to start with it down in here somewhere, and then we're going to wait and see how price action goes. Now, obviously, I'm not going to risk $394 to make $90. I'm not going to do that. But initially, if price bangs down and then bounces back immediately, I want the ability to adjust maybe my stop loss, and maybe if I want to take a position later in the day, maybe I want to adjust my profit target too. Now, as long as I do this stuff in a consistent fashion, I can do it on the fly. I don't have to have just a perfect plan going in. But let's just throw that down for right now and see exactly what happens. We've got 49,163. That's a little bit big for me. 55's fine. And then we'll go ahead and leave this somewhere in here. I believe that I don't like playing so tight right off the bat on a trade like this. But we do have an opportunity potentially, and maybe we'll even get this trade during the live stream. That would be absolutely fantastic. The market is coming our way. Is there a lot going for it to the top side? Absolutely. You've got that 30-minute 920. I don't believe that that's done moving yet. And you've also got sort of the intraday trend on the US 30 up about 250, and the macro trend we are driving almost each and every day, aside from yesterday, of course. Each and every day we're moving towards 50,000. I like this trade. I think it has an opportunity to win. The biggest thing you got to do is manage your risk aggressively. All right, let's see. Let me see. Eyes Hazy, good to see you. Eyes, we have a question. Why did the Dow go up as the NASDAQ went down and the market opened? That's a great question. And when we start, this is where the rubber meets the road and it gets really tricky. A lot of traders, there's an old saying, bulls make money, bears make money, and sheep get slaughtered. In a bull market, everybody just buys equities, they walk away, and they make stacks of cash. In a bear market, they short it, they make stacks of cash because everything goes down. The problem with trading is sometimes you get into a situation where the Dow's up and the NASDAQ's down. Commodities are up, and maybe the dollar's up too, and it just messes everything. It just messes all your correlations up. When you get faced with a situation like this, honestly, I don't know why. We're going to cover some data points that hit the market earlier today, weekly jobless claims namely. But if you get faced with a market that's mixed, this is what I call split. I mean, you have a split market today. The Dow's up, S&P and NASDAQ are down. You've also got a rally in the U.S. oil, rally in oil, and then metals are off a bit, led by silver. Essentially, what you're doing is you're just sort of throwing darts at a board today. What's up, what's down? Well, it's mixed. You know, U.S. dollar, Japanese yen's up, barely. Great Britain pound, USD, down, barely. It's tough. Fall back on your technicals. Fall back on your technicals. Don't rely on your correlations completely. You can't treat the NASDAQ like the Dow because they're very, very different. My guess is, and I don't know, I haven't looked at the energy stocks yet. My guess is big oil may be dragging the US 30 higher. That could be the case. I'm not sure. I haven't looked at it yet. Maybe we'll look in a minute. But anytime you have a split market or what I call junk or garbage or a checkerboard or whatever you want to call it, you fall back on your technicals. Don't rely on correlations all the time because correlations break down. They're not 100%. When I say that the Canadian dollar is driven by crude oil and natural gas, it really is. That's a major, major factor, but not every day. Not every day. It's not 100% foolproof. Nothing in this market is. Nothing in this life is. So be able to adapt and overcome. That's where your technicals and your ability to reason really come in. So on this US 30, we're definitely bullish here. I would absolutely love to grab a pullback zone late in the day from that 38%. That might be a hot little scalp. We'll see exactly what happens. Bitcoin, I wanted to start with Bitcoin, but hey, we sort of got sidetracked there. Bitcoin, you can see this is our monthly chart. Line in the sand for me is 78%, about 85.5. I think if we take that level out, you're going to go much lower. You're going to go to 75. Now, are we there yet? No, we're not there yet. But we're working really on our fifth week of absolute compression. Now, I would throw December out. I would say, well, December sort of didn't do much. Well, a lot of times December doesn't do much. Holiday season, traders are on vacation. You can see right here, downside support at 85 was great. Topside resistance at 95. What's happening at Bitcoin? 85, 95, 85, 95. So we went up and checked out 90, 94, 92, 89. Last month's high, this is very important, 94, 652. Then we come in with 94, 792. That's only about $100, somewhere in there, $140 above last month's high, and then you're getting the reversal. This is getting into what I call a failed auction territory. That means it's a decoy. It's a pump fake. A lot of folks were playing that breakout up over 94, thinking that 95 was going to be the catalyst to go to 100. There was a lot of bidders there, and man, they got hit. Those big shorts hit them like whack-a-mole. That old game at the carnival, you play whack-a-mole, pops its head up and you hit it on the head. That's exactly what happened to your bidders right there. They wanted to play that breakout out of December's range. Not all ranges are created equal. Clearly, that 62% retracement theoretically was a pretty darn good support level. Now it is great resistance. So keep a close eye on 95 at the top side. Right now we're down at 91, so it's a significant pullback, but the game's not over for the bulls. There's a lot of positions that are holding on from 85, maybe even 90, that are still in pretty good shape. You just are going to have to get some momentum to get up over 95. So right now, the market had the big move in November, and now it's getting compressed. You're seeing sideways trade. Buyers and sellers are hammering it out, and nobody's won. Nobody's won. Somebody's going to win. I guarantee somebody's going to win. Either the buyers are going to win or the sellers are going to win. For me, it'll be pretty obvious that the sellers won if we do trade beneath that 85 level. Then I expect some major action to the downside. So a bit stronger dollar today, up about 0.25% on the dollar index, sort of leading to a little bit of pressure on some of these other assets, specifically metals and crypto. Crypto's getting hit pretty good, but not really. I mean, to be honest with you, it's red, but not much red. It's not like a 10% loss or something like that. This is interesting right here. Here's your dollar index, a monthly chart. Important that we understand our monthlies as we roll into the new year. What did we really get last year? Well, we got the inauguration of Trump. We had a dollar that absolutely plummeted for 6 months there, and then we sort of flatlined here as we got into sort of the Fed rate change policies and all the different speculation and uncertainty that we saw through the late summer and fall months, right? Well, actually the summer and fall, so about half of the year was absolutely flat. This is a textbook L formation. What an L formation is it's very bearish. There's your run, there's your rotate. So to the top side, very simple to read this type of chart. You've got a resistance zone right up in here. I would even expand that just a little bit. We've got the 13-month EMA right up there about 100. And then you've got that 38% up about 101.50. That's going to be a really interesting zone. If the dollar can break above that, you're going to maybe see a rally, maybe up to 103, 104. Personally, I'm bearish this year, the U.S. dollar. I think this is an incredibly robust signal that you're in the beginning of a major downtrend. In my view, the dollar index, if you're a smart money trader, I know a lot of you are, I know I say that every day, that area right there is probably what I would be looking at. That value zone right there, that order block back in January of 2021, I think we're going there. So where is that? Right around 90. Big round numbers to start the year. There's nothing wrong with that. I like easy. Easy is good. Easy is good. That's for sure. Okay, so that's a look at the dollar and the US 30. Let's go ahead and take a look at a few of our fundamentals, and then we'll dive into our metals markets and take a look at whatever you guys would like to look at. If there's any certain pairs you'd like. I got a couple requests via private message, so I'll work those in as well. Monday was nothing. ISM PMIs. The most important thing about Monday was Venezuela and being the first trading day of the year. Tuesday, German CPI and S&P global PMIs. Once again, not much there. We're still trading Venezuela. Yesterday was a little bit different. We had the employment numbers, ADP and JOLTS. We chose to do the webinar instead of covering those. I put out a trade idea yesterday that covers the ADP employment and JOLTS jobs numbers. Today was the weekly jobless claims. Now, we did see some market turbulence around these jobless claims. Sort of funny because typically I don't put much stock at all in the jobless claims. I think that on a weekly basis, they're not very meaningful. They don't have a whole lot of gravity on the market, but now they do because everybody's really concerned about the state of U.S. labor. Essentially, what traders do, fundamental traders and economists as a whole, what they do is they say, are we in a growth or a contraction? Are we expanding or contracting? Are we going into a recession? Are we going into a depression or a boom? Because it's very simple. If we understand that we're going into a boom, we put everything risk on and we walk away from it. That's what the big money does. That's what the institutions do. That's what your high net worth investors do. Okay, as traders, we're in it day to day, but still understanding these trends helps us out immensely. Now, if we know we're going into a recession or an economic contraction, it's very easy. We either take profits and put it into a safe haven, or we short the markets. It's that easy if we can understand that. That's why these jobs numbers are so important. It's why the growth numbers are so important, because the big money, the capital, In this world, they trade according to macro trends. They're looking at what's going to happen to these economies over time and what's coming next. Not just maybe this year, but 2, 3, 4, 5 years out, right? So if we understand that maybe U.S. labor is not where it needs to be, then we have a major problem. We're going to have policy moves to shore that up, and it's going to affect valuations of assets, everything from crude oil to baseball cards. It just is. So when we look at something like the weekly jobless claims, we've got the people that believe that they can look at this in a very granular sense, week in and week out, and project accurately what's going to happen in the near term. I don't know that it can be done. I don't put much stock in it, but a lot of people do. And today, we saw some movement on these numbers. So let's go ahead and take a look at our initial jobless claims, which really is the big figure that you want to look at here. Challenger job cuts, I wouldn't worry about that. Continuing jobless claims, once again, you don't really need to worry about that. That's just a measure of everybody that's still on the unemployment rolls. Import exports, forget that for right now. We'll talk about that quarterly. Initial jobless claims, 208,000. Now, these are new folks in the unemployment rolls. These are the folks in the unemployment line to sign up for their benefits, their unemployment insurance. 208,000. Those are new entrants there. That's beneath the 213,000 we expected and the 200,000 from last time. So 200,000 to 208 week over week. So we have an initial jobless claims are increasing. So what does it all mean? Not a whole lot. Initial jobless claims in the U.S. rose by 8,000 from the previous week to 208 on the week ending in January 3rd, loosely in line with market expectations at 210. Okay, that's fine. How about the trends? How about the macro trend of 1 year? Where does this week's number fall? It's low. Take a look at where we've been for the last year. Okay, sure, there's some growth here, week over week. And, of course, right back there, that was a great week, right? Nobody went to the lines. But look at where we've been running, really. This is the first year of the Trump administration. First year. Things were getting pretty ugly right here. If you were watching the live streams, especially right here in April, I was calling for a recession. I thought a recession was almost guaranteed. Didn't happen. Jobless claims a lot higher. Pulled back to this dip. This dip right here in June, late June, still much higher than what we posted today. The trend is down. Even though you're up week over week, it's been a pretty darn good December. So we'll see exactly where we're at, probably by the end of Q1. But the jobs sort of all points towards a robust NFP number, even though we are expecting a bit of a contraction. That's why NFP Live is going to be so important tomorrow. There's a lot on the line. There's going to be a lot of volatility. So definitely tune in. We'll have that starting for you about 10 minutes ahead of the release. So about 8:20 a.m. Eastern, I'll be on. Maybe earlier, who knows? But we'll plan on 8:20. We'll meet you back here. All right, this is the gold market. Now, all-time highs, we were relatively vocal about this, 45.50. This one at 45 was a banger. This number went right up there and just sort of hit perfect and came off for us in an absolutely beautiful fashion. Now, unfortunately, we're a little bit late to the party today. There was an opportunity to bid the dip, and if you got it, you nailed it. I mean, if you're Fibonacci, bound. Spike low there on the 31st of December. Spike high right there on the 7th of January. We pull back down to 44.13-ish. Bounced up to 44.49, 44.50. This is still a very bullish market. Very, very bullish market. No question about it. If you want to go down and look at short-term price action, we certainly can. What do you have here? Perfect. Realistically, that's I always talk about shading our entry. You'll notice in our trade ideas, we always shade the entry by a few pips, something like that, or I take it up to a level that I really like. That's the trade you want. That's the easy money. That's the path of least resistance. I believe in easy. Easy is good. 44.13 sort of was your entry point there. What's your low right there? 44.15. Whew. That's a pretty good one. And then you get that big rally right up there to 44.39, and that's a $25 move. And even the second way, let's say you wanted to wait for a little confirmation. This is exactly one of the approaches that I use when I'm trading horizontal support and resistance levels, is I'm looking for confirmation. Anybody know what that is? That's a hammer. That is a hammer right there. I love to see that. Anytime you see, that's a hammer right there too. But notice, you boom, right there, you get faked out, then you come right down, you test that support level again. There's your hammer. When I'm talking confirmation, this is way too high. This trade location is not good enough the second time on this level. That right there, though, that right there, where you take out the level, you come back on your hammer, and you close above said level. 5-minute chart, macro level, beautiful confirmation. Maybe we'll shoot some videos on the hammer. I love the hammer. The hammer's good. Believe me, the hammer's good. In any case, 5-minute hammer right there, and the rest is sort of history. Now you've got the big rally. The rally's on. Folks are buying it. If you wanted to trade this one intraday, I really wouldn't recommend it late in the day like this. With the US 30, you're liable to get some pretty good action on the price. But as far as what we've got going here, something like this, spike low, spike high, you've sort of already missed it. I wouldn't mess around with this. If you didn't already get the daily, which, we sort of missed because we got on late. But if you didn't get that one, you probably want to wait. I don't know that I would be trading a trend day up during the U.S. session right now. We're still sort of flat in gold. I'd let this market sort of iron itself out. All right, let's go back over to the US 30 and see what's going on. What did we get right here? Okay, we came down. We hit that on the daily. Let's look at our 30-minute. Yeah, I don't know if we're going to actually get in this trade or not. You'll note. Remember, we had our 30-minute Fibonacci's were like this. Somewhere in there. That's actually very good. Spike low, spike high. We may get it. We may not get it. Probably not going to get that. Somewhere in that zone. All right, so there's gold. There's silver right here. Silver's a little bit dirtier than gold right now. You've got silver off about 3.25%. Gold's pretty flat. So this is one of those where that gold-silver ratio is sort of getting a little bit bigger today. With regards to where we're at in silver, I mean, the market is so incredibly bullish. Are we topped out in this market? Or are we going higher? I've heard projections going as high as 120. Some say 200. I think that's a little ambitious. So if you're a pattern trader, you take a look at that daily chart. I've got my key levels outlined, 80s there, 84, the all-time highs there. Let's get rid of that stuff. What do we have? If you're a pattern trader, and a lot of you are, check it out. I'm not a very good artist. You're going to have to bear with me. Watch the next couple days. Cup with handle. Daily cup with handle around all-time highs and key levels. Ooh, that's one of those that you need to be aware of, because if, in fact, this thing does break, I can't remember where my curves are. Yeah, here we go. If this cup with handle does break, if it sets up, and it looks like it is, look what you have here. All-time high. You've got a key number at 80. We had all that marked. Well, what's coming up next? If we get this compression, which it looks like we're going to get potentially. Now, I would say let that sit for another day or two. Cup with handle. You'd be looking at a breakout from the handle, potentially going much, much higher. We've had some incredible success spotting cup with handles in the trading room last year. Daily time frame. Don't love it as much as weekly and monthly cup with handles. Those are macro movers. Those are big movers. But for silver right there, you're definitely still looking to the top side of this. Now, I know it's getting hard. It's getting hard. I mean, that's a lot of pain right there. Down 3% yesterday, down 3% today. That's about 6%. But, man, you're still at $75. I would expect a little bit of support right there. Is it time to buy silver? Well, if you wanted to play a pure breakout, you need to let this set up for a few more days. So I would say at least let this set up tomorrow, and then you're simply just going to buy above the trend line we establish in the handle, and we'll be able to dial that in a little bit better as the handle sort of forms. Or you could be looking sort of at a conventional approach, something like I would be looking at, where you'd grab a weekly, and you'd say, okay, cup with handle. What does it mean? Can I buy any retracement levels on the weekly? It's kind of tough. You're going to have to go all the way down there to find really a spike low to work off of. And there's going to be your key level right around 69.50. So you have a couple of approaches here to trade silver. I believe you still trade silver to the top side. Now, I'm not saying that these metals won't wash out and come way off. I mean, anything's possible in the market. That's sort of the lesson for today. Anything's possible in the market and in life. But we have to be realistic about what's going to happen here in the United States. There's going to be an impetus for precious metals. They're important. Silver is one of the building blocks of your AI revolution. It's going to be used in every data center they build. They're going to need a lot of silver. They're going to need a lot of copper. So when we start looking at something like silver, and everybody's talking about it, everybody's talking silver right now. So we'll talk silver and sort of show you exactly what you should be thinking maybe to trade this thing. A big pullback would be very great. It would be great for retail traders. Well, let me rephrase. It's going to stop a lot of folks out that are traders. But for retail folks like us, we sort of know where we can nail this market, where we can really hit it. We can hit it at 38%. We can hit it down here at 60 and maybe even 78. And what do those numbers really look like? Notice I skipped 50. I'm not interested. Notice what they look like. 69.50, 60, 53, maybe 54. Just basic proportionality in a robust uptrend. I believe the macro trend for silver is going to hold to the top side. Very intrigued by this daily chart. So if we do get a big pullback, that's great. I'm more than happy to scrap this cup with handle and just bid down here. I have no problem with that if we really break down and get after it. So right around 69.50-ish, maybe 69.75 is a nice aggressive trade. Probably 69.55 though if you're going to play real tight scalps. Somewhere in that zone could get a nice bounce. Definitely something to think about if you're looking at silver, and I know most of you are. Now, to show you sort of a contradictory situation, well, we're not going to get that trade on this live stream, so that's unfortunate. I wanted to execute that one. But when you look at silver, 920 EMA, right? Here's your 30-minute. Your 30-minute chart did what? Okay, you had a bid right here. This is classic whipsaw action, absolutely classic stuff. Right before that Tokyo session last night, so you had a buy signal and you bought, and then you got chopped out. Could have been sort of a really small loss, though, not a big one. Then you get the sell signal, and then you get chopped out right up there. That would have been close depending on where you put your stop loss. More than likely, you probably would have got stopped out, especially with that buy signal. So I would say that when you're faced with this type of situation in the 920, buy, sell, buy, don't take any of them. It means that we're choppy. When you see a frequency of a lot of signals on a crossover strategy, don't take them. Step out. Let the market commit. Let it do something. Sit around and wait for one of these to fail. You could have waited there and got in there, and at least that way you only lose once. But really, take a look at what you wanted to do. Man, that one right there really called the trend. You see that? That's a no-no. Buy, sell, buy. Stay out of all of it. Let a few price bars set up. Give yourself a chance. That right there, there's your sell. This right here, interesting though. Is it time to buy silver? We've got a 30-minute sort of cooking. Let's go to our 4-hour. 4 hours got you selling. Now, you'll notice with the 4-hour chart, you avoid all that noise we just saw on the 30-minute chart. So something like this, is your sell, valid? You probably could play it. It's possible. Where's your stop loss? This is textbook why I just don't recommend the stop loss above the trigger bar there. So if your stop loss is right there, you're already out. Probably somewhere right up in there. So you'd be looking at a stop of 79 with a position. If you sold it right now, you more than likely sold it down here at 74. But let's say you sold it right now at 75.50. Remember our macro analysis, still have quite a bit of room down there at 69. It's very possible. Just remember that if you take a trade like that, you're fighting a really stiff trend. I don't know that that's the answer. I don't think there's any reason to reinvent the wheel or do much of anything other than follow the uptrend. For me, if I'm looking at the 920, I'm looking at my buys, especially on a 4-hour time frame. Look at that, sell's a loser. That buy is a pretty big winner. Does this sell create anything for us? I doubt it. If I was going to pick one to lose, it would be this one. You're not supposed to second guess systems, especially if you have a system built. I definitely recommend not second guessing it, but that right there, probably I think it's a high risk trade. I really do. You're fighting too stiff of a trend, even though you're off today. The top side of silver really is magnificent. It really is. Well, let me see, Steven. Okay, we got a couple of questions. Fantastic, guys. It's a market blitz. Anything you want to look at? I'm more than happy to open up the floor. All right, let me see. T Marina, Shane, can we check out Meta, please? Yeah. Let's look at Meta. We'll throw some Fibonacci's up there first, and then we'll go ahead and see what we can do with maybe that 920 on a daily. Okay, here's your daily. I always like when I'm looking at stocks to step back. I always feel like sort of an investor with stocks, maybe a swing trader, not necessarily a day trader with stocks, but a lot of folks really do, and they do very well at it. As far as your monthly goes, nothing really there to glean, in my opinion. The only thing I would look at is my 13-month EMAs at 650. That correlates with a big round number. You've seen compression right there. That would be the point of control over probably the last, if not 90 days, definitely 60 days. A lot of business done at 650. Is it support or resistance? Well, we're finding that out right now. Probably wouldn't want to buy south of 650, but we can definitely look at it on a shorter term trade. Maybe we can get a few percent on this thing. Let's go to a weekly. Okay, so if I wanted to buy into this market, I was like, okay, let's buy. I'd wait for a deeper pull. I mean, right there, spike low, spike high, compression throughout December. Shouldn't surprise anybody. Your next earnings report is coming, the 4th of February. Keep that in mind. But something like this, maybe you get a nice sell-off here. Maybe we get some pressure to enter the market. Maybe we could step up and bid like a 610, 615. You could bid the back into this golden zone too if you wanted. I mean, let's be honest. I mean, this would be a very conservative trade. We know we have a point of control at 650. That means there's a lot of business that's been done at 650. Can we just mark it? Let's just mark it to show you. 650, somewhere right in here, ballpark it. Okay. There's 650. Okay, so we traded it here. We traded it back in here. Really got away from it. But like the last month or so, 1, 2, 3. That one right there didn't. That was Christmas week. I would throw that out. 4, 5. So we've traded 650 almost religiously over the past 6 weeks, right? So if that's the idea, is it worth it for me to step up and buy the back into the golden zone at $6? It's $631. Well, let's say my profit target was 650. We pull out the calculator. We go 650. We go minus 631. That's $19 a share. Divided by what? 631. That's what we got sunk into it. That's about a 3% return. That's realistic. Is that even worth it? I don't think so. 3%. I mean, you can do it. You can do it. But where do you cut this trade off? If you buy 631s, where do you cut it off? That means you're going to have to be really tight with your risk management here and your stop. You're going to have to sort of bail on the position, probably right underneath that quarter handle. So if you're looking to grab, what is that, about $18, something like that, $19 in profit, you probably don't want to risk much more than that. So I'd be down maybe in the 12 range. It may be better to wait and get a stronger opportunity down there. Maybe it's 610. That may be the way to play that meta. Then again, it may not be. You might just want to buy it right now and walk away from it. You might want to sell it right now. For me, I'm not interested really in selling much of anything with stocks, not when we know what's coming with interest rates and also energy. Energy is a big, big thing. And even if the United States starts securing huge natural gas commitments, look at the price of natural gas tanking this time of year, down around 3.5. Natural gas is creating a lot of AI steam. Meta is deep into AI. In a lot of ways, Meta is going to go as AI goes. So this is interesting stuff. I mean, it really is. I want to be on the long side. That's just my opinion. But if we're talking about a strong trade, you probably want to wait for a deeper pullback. You want to see a deviation from 50 and maybe buy the extremes of the sell-off. That would be my opinion on that. Okay, let's go to, let's see, what else do we have? Euro USD and USD Japanese yen. Okay. Okay, so Euro USD, we had a lot going on here on a weekly. We sort of had an ascending triangle. That's what we were doing quite a while ago. Take a look at what's happened now. Nothing. You still have an ascending triangle. This market has dried up into nothing. I mean, it really has. It's been really a challenge. So if I'm looking at this on the weekly, I still like 120 to the top side as being a potential key level when the dollar actually does start surrendering market share again. But right now it's taking a pause and it's doing okay against the euro this week, off about 0.6%. So if I'm looking at maybe potentially bidding this thing, 50%, I don't care. I don't want any part of it. Now, a lot of traders swear by the 50% level when it comes to the Euro USD. They swear by it. For me, I'm not interested. I'm a sort of a stickler. I'm going to hold out for a better deal. And if I miss the trade, I miss the trade. I don't care. Let's take a look at the short time frames here and see exactly what's happening at our 50% retracement on the 5-minute. Okay, this is interesting. So what do you have? There's sort of our level. There's our 50% zone, 116.48 ballparks, right around 116.50. And what do you have? Took it out, and then there's your hammer. A lot of hammers around these levels. There's your hammer, 116.43. And since then, you got a nice rally up to 53, so about 10 pips. And you could see, I mean, if you wanted to be maybe a pip scalper. And I'd say, okay, what's my spread right here? I'm looking at 0.3, 0.4 pips on my spread. What could I do to build a true tick scalp here? Turn on my paper trader again. Not real big on paper trading. I like trading with money. Right here, limit order. You'd be looking to buy right down there. Something like that. Okay, so what would it look like? What would your take profit look like if we're pip scalping? If we're just want a couple pips. We've got everything we need. I've got a tight market. I've got a lot of liquidity. I've got 0.3% or 0.3 pip spreads. That's fantastic. That's going to let me come in this trade maybe shooting for 3 pips and actually make a horse race out of it. A couple of ways to execute this trade. The first way, if you truly wanted to scalp, you could be looking for something like that, right up towards the top of market structure, somewhere right in that zone, right up towards the top here. Stop loss, you don't want to get it, risk any more than one to one. It's got to look something like that. That's a very tight trade. If this thing so much as hiccups, we're going to get stopped out. No question. Now, let's say I wanted to build a different trade and say, okay, I really like my 50%. We're going into the dead part of the U.S. session. What could I do with this? You can do something like this. You put this down below this hammer, right down there at about 116.42, and maybe say, okay, I'm going to bid my accumulation trade, and I'm going to go ahead and enter the trade right there at 116.48, and then maybe I'm going to look for something like this. Maybe I'm going to look for like a 56 or a 58, and potentially maybe hold that thing at NFP, maybe with a 1 to 2. I mean, we've got all the reasons in the world to do this. If you're a smart money trader, you definitely probably be looking at this order block right in here, this sort of mess. You can say, okay, I'm going to shoot for that mess, or you can shoot for up here. I mean, this is really realistically, we don't need any indicators for this. Just our support zone. Maybe you can shoot for that liquidity sweep up there. You can see how lucrative things really get. You start hitting those 4 to 1s. You don't have to do it very often. Now, full disclosure, 5-minute chart, you're going to be in this trade a long time. If you're looking for 116.72s, you're buying 116.49s, and you're risking 42s. Very, very, very tight trade. You're betting that your support zone is going to work, and you're betting that the accumulation will come to pass ahead of tomorrow's NFP report. I'm not real big on that. I mean, I would just be a tick scalper, be dedicated to the game. You know, it's only with our leverage. What are we shooting for? $30. It's probably a legitimate trade for real small retail traders. Let's say you only have $500 in your account, shooting for $30. Is that not a reasonable risk? What's $31 divided by 500? 31 divided by what? 500. About 6% risk. You're getting up there for longevity's sake, but at the end of the day, if you have a $500 account and you want to make a few bucks, you're probably going to have to risk stuff like that. That would be a trade where you could probably get away with risking 5%. I told you, sometimes I'll look the other way on a 5 or a 7% risk. You know, you're going to have to get paid for your time, and if you have $500 to trade with and you lose 4 or 5 of these in a row, you're in big trouble. But, you know, you got a pretty good chance of winning that trade, especially because your profit target's so modest. That's a pip scalp. You can execute that trade in this environment. Now, as far as what are we looking at for the Euro USD big picture, I'm sort of bullish. I really am. This is a nice correction, though. No question about it. Nice correction. Really a great buy would be down here at 116, 116.10, back into that golden zone on the weekly. That'd be fantastic. Even better is 115.50, but we'll be right there at 116. This trade was great. Earlier this week we took to lead off the trading year, actually. That was a really nice trade. Since then, we've really come off. 38% gave way. Now we're testing 50. Probably going to head right down the queue, at least for the foreseeable future. Maybe NFP brings about a reversal. All right, let's go ahead and see the U.S. dollar, Japanese yen. And then we'll go ahead and we got one question about psychology, and then we'll go ahead and sign off for today. U.S. dollar, Japanese yen. You know, the real story of this yen is, you know, why is it up? Bank of Japan raises interest rates. We're thinking a hawkish BOJ. They're that worried about inflation in the balance sheet in Japan. Why, oh why, is this thing still in bullish territory? Why haven't we seen the big correction? Well, there's a lot of reasons for that. It probably was already baked into the cake at some juncture. I think it's going to really depend on what happens with the U.S. Fed. Who's going to be the new Fed chief? Who are going to be the new FOMC members? Who's going to be running the show? How low do interest rates go in the States? what does the Bank of Japan do with respect to that lower U.S. interest rate? It's going to be a fascinating dynamic. Expect volatility. I don't know whether we go lower or higher. Common sense says you're going to go lower in this pair, especially if the BOJ holds and raises and the U.S. decides to cut and go dovish. That makes sense. We're going to come down, but we haven't seen that yet. When they made the BOJ made that move back in December, we saw a major move, plus 1.25% that week. Okay, that flushed out all the retail shorts. That hit everybody hard. So when we look at these things, we say, okay, how do we trade it? Well, first things first, we could take a look at this and go, well, I mean, the obvious thing, and a lot of folks would do this on YouTube, they'd say, oh, it's trend line. You see right there, we could have built maybe 2 touches right there and then looking for the third touch, and that would have been sort of your third touch right there. It would have acted as support. Now, remember, you're going to want to dial these in as close as you can, but it's not an exact science. It really isn't. But we see the weekly trajectory there. The third touch is everything with trend lines. Right there. 1, there's your spike low, there's your hammer. All right, our Euro USD trade just went live. What happened? We got to watch that, don't we? Sorry, I'm jumping around. Well, we're in here somewhere. Must have been on a different data feed, but in any case, we're looking for something to really come back up here, right around 116.51, something like that. I think we've got it rolling. In any case, dollar yen, you can see right there, spike low there, spike high, right? Or excuse me, spike low, spike low. That's the second touch. The third touch is right here. The third touch, we come down and hit, and now we're getting into really where the rubber hits the road for this dollar yen on the weekly. Still bullish. We're above the trend line. You're still bullish, but if you get a bearish close down in here somewhere, you're going to have a real opportunity to potentially get involved with a little bit of meaning. Meaning, if we get a weekly close beneath this trend line, probably going to be a lot of position shorts coming into the market, and they're going to look a lot like this. Let's say we get a close down in here. The shorts are going to be right there. They're going to lock in right above sort of this triple top and then potentially shoot for that fundamental trade to come in. Basically, it'd be sort of an inverse carry trade. That's why a lot of folks believe the carry trade's over with the dollar yen, meaning a lot of traders and investors are going to start favoring that yen a little bit over the dollar. That's going to be new. That's new ground. It really is. So something like that's very interesting, especially when you got that weekly triple top. Now, we can get rid of all that. Let's go ahead and leave it. We might revisit this tomorrow on NFP. But the big thing to remember is we sort of just drew a cup with handle, didn't we? If I can find my curves again, we'll do it again. Boom, there we go. Something like this, right? Cup with handle. This is a weekly cup with handle. It's bullish. So what does this mean? Your handle's pretty much already formed. I mean, the cup would look something like this, essentially. Your handle's about 3 weeks deep. You get a real tight compression week, you could definitely be looking at the top side of this market. So there's lots of reasons to buy and hold. If you're long, you probably hold right now. The reversal really comes if we get a big weekly sell-off and break down, really eliminate this handle and trade beneath that trend line. And that's when we can really build something that's pretty tasty, pretty good trade. So something like that that's what I would be thinking for the U.S. dollar, Japanese yen. We'll dig into the dollar yen more tomorrow, but for right this minute, you're probably slightly bullish, holding on to that. With sort of the caveat being NFP tomorrow, if you get that big move, then we're going to have an opportunity maybe to get in there and make a few bucks. All right, back to our Euro USD. This is coming off a little bit. I can't remember which data feed we had our trade on, actually. Which one was it? Maybe it was this one? I don't remember. In any case, which chart? That makes me angry. Which chart was it? Oh, the pleasure. Okay, so we're down right now. We're down $19. Okay, let's go to our 5 minute. I want to monitor this thing just for another 2 seconds and see where we're at. Okay, we're going to lose. We're going to lose more than likely. Why are we going to lose? You see right here, we came down, we took that level out, and then it sort of acted as that bottom on the 5 minute intermediate term, bottom, and now we've broken. So once that support line is gone, you're pretty much going to get washed out. I would bet right now that we're going to lose. I don't play 50% levels. That's a weekly 50%. I don't care. 38, 62, and 78 are what I like to do. 50% not really my cup of tea, but we'll see. Maybe it rallies back up and we get lucky and it pays us off. Good question right now psychologically. If you're in this trade, put yourself in this trade right now. You've got a $500 trading account. It's gone against you. You've risked $31, which is 6% of your account on this trade. The market's going against you right now. We're almost to the point where we're going to get taken out. If we don't get taken out right now, is it wise if price rotates back up to our break-even point, back up to our entry? Do we just cut our losses and get out there? I'm going to leave you with that question. That's going to be one. Think about it overnight or think about it in the next sessions. If the market goes against me, this thing hasn't gone positive at all. If it goes against me and it's looking bad and then it bounces right back up to my break-even, do I get out there? Maybe, maybe not. Something to think about. In any case, we just got knocked out of that one, so that was a $31 loss. Oh, well, we'll have to learn to live with it. All right, got a question here over in the YouTube live chat, and then we're going to go ahead and call it a day. We've gone long enough, almost an hour. Actually, I forgot to cover the news. All right, we'll do this question, then news, and then we'll sign off. All right, Eyes, why do my stop losses seem to almost always get taken out, and then the market moves in the predicted direction? Yeah, well, I mean, where are you putting your stop losses? That's the big question. If your stop losses are getting triggered and then the market's reversing and this is happening consistently, I recommend two things. Number one, evaluate where you're putting your stop losses. Odds are you're getting hunted a lot. And that means that you're putting them in obvious positions. You're probably putting them right beneath swing highs, right above swing highs, or right beneath swing lows. Maybe you're putting them right above or below price bars. Those are very, very obvious locations. I'm not saying they're wrong. If you're making money, it's the right answer. But if you're losing money, take a good look at your stop losses. Where are you putting them? Maybe you're putting them too tight. This admittedly was very tight, but I have a lot of confidence that this thing's going to keep going down now. So the first thing I would do is evaluate your stop loss location. Now, the second thing I'm going to tell you is something that people probably don't tell you ever because it really puts a lot of pressure on our limitations or the ways that we think as traders. One of the biggest things you have to do as a trader is you have to be able to let go of everything and hold on to everything at the same time. Really contradictory. And I don't know if I should even give you this tip, but it's something that I've done in the past, and I've seen other people do it with a lot of success. If your stop losses are getting taken out often and then they're reversing consistently, put your entry point where your stop loss is. I mean, if you're getting hit and the market's reversing in your favor repeatedly, put your entry point on your stop loss. So let's take this trade, for instance. Let's say you bought here. You're consistently getting stopped out here. Your stop loss, you're putting your stop loss here. You bought here. You're consistently getting hit and then rotating back up. So the idea, just so we're clear to everybody, is you're entering here, you're getting hit here, and then the market's going this way. How could you remedy that? I know it sounds really simple and stupid. Buy the market there. A lot of traders have done that over the years. They said, man, every time my stop loss gets hit, it bounces back in my favor. I'm going to start buying my stop losses. I'm going to sell my stop and buy my stop. You know what I mean? Think about it. It's not that you're necessarily doing anything wrong. It's actually quite the contrary. You're identifying ranges very well. Your technicals are probably spot on. They're just opposite. They're just inverse. It doesn't mean anything. I always tell people they get so caught up in back testing and they want to see positive results in a positive equity curve. Give me a negative equity curve and I just flip the parameters and we win. I mean, if I'm buying every day at 7:30 and I'm losing 80% of my trades, then I start selling every day at 7:30. Very simple fix, but it's hard to think that way. It really is. Well, if I do that, I'm compromising the integrity of my strategy. Fine, build another strategy. There's no rules. There's no rules in this game. You do whatever it takes to make money. You do whatever it takes. All right, T. Marina, that actually makes sense. Placing entries on continued stop loss levels. Well, yeah. The real question, and honestly where it gets really hairy, is let's say, you're buying consistently, you're buying up in here and you're hitting, 60% of the time up in here, and you're getting stopped out. The question is when does it become worth it to skip this entry for this money and take this entry for this money? And what I would say is study your losers. If every time you lose, let's say you're hitting 60% of these trades, you're still losing 40%. On that 40% you lose, on those that you get triggered, 90% of them rally back up to break even. That's a no-brainer. Start buying your stop loss. I mean, these are the ways you think about trading. Take a look at what's happened here. Take a look at what's happened to us. The market's out of here. We're not stupid. We knew where our stop loss needed to be, and we cut the trade off. If we took a position, I could have very easily done this, and I said, okay, well, now it's a position trade, and guess what? We're going to get eaten up. The bottom line is the support level didn't work. It was saturated. It had been hit multiple times. Now the market's coming off. We're getting our ass kicked. It's a good thing that we're out. It's a good thing that we're out. All right, guys. I've gone on long enough. T. Marine, I've noticed that on a series of consecutive past trades. Number one thing I say, if you're having trouble, study your losers. I know why I lose. I've been doing this for a while. I know exactly when I get into a tough spot, I know exactly why I struggle. The losses, I can almost attribute most of them to just trying to chase money almost every time. That's why the 2-loss rule is sort of fits my personality. I have to shut down the aggressiveness. And after a while, it just becomes second nature. You go, okay, I lost twice. I know what's going to happen next. See you tomorrow. See you tomorrow. All right, a couple of news stories maybe to watch over the coming days. Trump says U.S. to ban large investors from buying homes. This is interesting. This is also a potential equities market driver. You'll see the hedge funds start pulling out of real estate because they can't buy whole neighborhoods and hold them and sit on them. You'll notice things like BlackRock. They're going to have to find somewhere else to put that money. Homes have turned into not necessarily a product, but a commodity, believe it or not. They believe that housing is a commodity. Well, it's not supposed to be. It's supposed to be a product. In any case, this is big. This could definitely spur more investiture into our capital markets and take it out of the real estate markets. That's big. Venezuela watch. We're watching basically the Senate's upset about what Trump did, and they're trying to get some war powers measures passed. I don't know that they're going to pass, but this could be very, very important when it comes to launching potentially another attack to ensure that, or another strike, or whatever you want to call it, to ensure that there is peaceful elections and a peaceful transfer of power in Venezuela. This is potentially a big deal. I'm watching this. Sort of been quiet on the Venezuela front the last few days. Fed watch, 19 days, 23 hours. We're still basically pricing in a 90% chance that interest rates stay exactly where they're at. And then lastly, the Minneapolis situation's pretty ugly, and it's going to get worse. No question about it. You've got those of you that were watching the news or in the markets back in 2020. Pretty rough stuff in Minneapolis. Knew a lot of people in Minneapolis. Pretty rough stuff. And so what you're seeing here is potentially an instant replay of that. We'll cover more of this stuff as it's warranted. Maybe I'll do a breaking news brief or something. But this has the potential to be riots. We could see large-scale rioting. We could see National Guard deploy. And what that will all come back is it will all come back to Congress trying to figure out if it's lawful to put National Guard in there to reinforce order. It could turn into a real domestic quagmire here, and that can impact your markets. 2020 was an interesting year on the markets. Those riots and the civil unrest were one reason that drove the volatility. I know COVID was the number one, but those riots and the election and the politics really drove a lot of it as well. Okay, everybody, I'm going to go ahead and sign off right here. One more question. T. Marina, won't large investors just find a loophole? Well, by large investors, I'm not really, investors are sort of, if it's me and you, and we pool our money and let's say we have, $20 million to play with and we want to go buy 10 houses, they're not going to do anything to that person. What they're going to do is they're going to shut down BlackRock, which has bought entire neighborhoods before they were even built. They did that a lot in Arizona. And when you see, it's not right. There's a couple of drivers of the housing crisis here in the United States. From my point of view, that's one of them. That's a big one. You're just instantly taking that supply off the market. And when you do that, you're inflating the value of all the existing homes as well because there's just nowhere to go. There's nowhere for people to go get. I mean, the loans are there. The loans are available right now. The money's there. It's just not. It's not a function of liquidity. It's a function of supply. And when you have hedge funds that, I mean, seriously, T, what do you do when BlackRock shows up and they say, okay, we're going to allocate $10 billion into buying property in single-family housing in this region? $10 billion, $5 billion, that buys a lot of single-family dwellings at $400,000 and $500,000 a piece. It buys a lot of them. So that's what's happening. It's been happening for a while. And if you're talking about solving a housing crisis and returning this market back to what it needs to be, which is a free market, an open market, supply and demand, coupled with liquidity, you have an efficient market. And we can figure out, you and I can figure out what something's worth. When I always have BlackRock bidding against me, I'm never going to win. And it's not that I show up to buy a house and BlackRock's there bidding against me. It's not like that. It's like, well, there's no new supply coming on the market because, and I'm using BlackRock as an example. They all do it, JP Morgan, State Street, you name it. But if there's a new subdivision right outside of town, I said, okay, I want to get a house in there and I'm willing to pay XYZ, and BlackRock or State Street or any of these people come in and they pay 30% over what the realtors want to market it at and what the builders need to get out of it. If they show up and pay a 30% premium, it's over. That stuff doesn't even hit the market. So if that's the case, what does the consumer do? You can't fight those folks. They got too much money. I think it's a big deal, and they're going to have to find, if that does go through, and I don't know if Trump can do it or if Congress will do it. A lot of them are friends with those people. But if that is the case, then yeah, you're going to see a situation where potentially those hedge funds are going to have to put their money somewhere else. Could be anywhere. I think a lot of it's going to go into crypto. You're going to see crypto. You're going to see stocks. You're going to see bonds maybe. Depends on what the yields look like. All of it's hard. None of it's easy. Don't worry. We'll be here every day to figure it out. So good question, T. Marina. Vasu. Hi, sir. Hi, Vasu. Good to see you. Welcome. Okay, guys, that's enough for me. That went way too long today. Got a lot left to do. Probably get a trade idea out later today. Remember, NFP Live tomorrow morning, bright and early. We'll be on about 10 minutes before the release. I'll go ahead and I'll break down, I'll preview what NFP is. We'll go ahead and make some trades. We'll take a look at some key levels, maybe get in there and see exactly what these jobs numbers mean. We're going to look at those revisions too. I'm a stickler for the revisions. We got to do that as well. All right, everybody, have a fantastic day. Have a better trading session. Trade the action well. We'll see you tomorrow at NFP Live.